Hey there, everyone. Just want to send across my weekly market update for the week of January 12th through January 16th. So let's jump straight to it. So, first is going to be kind of talking about the big macro headlines, something you may have seen in the news this past week. So, big picture, first one is you may see the headlines talking about the rise in mortgage debt. That does sound a little bit scary at first, but kind of understanding the context does matter. So when you look at the mortgage debt compared to the overall size of the economy, it's actually well below where we were in 2008. So this tells us it isn't a big debt bubble like last time. So a couple things that could happen to kind of raise the mortgage debt is going to be, home prices are higher than they were a few years ago. So new mortgages are, higher than they have been in the past years. People are still buying homes, so more loans exist overall. And the last thing is, some homeowners are refinancing or using home equity loans, so that could also affect those higher rising mortgage debt overall nationally. And then next section, affordability isn't snapping back overnight, but it is slowly improving. So rates have come down a bit from their highs. Wages continue to rise. And over time, that combination helps buyers more than big headline moments do. So we are seeing a little dip in the rates. So overall, we're kind of seeing things kind of flatten out a little bit, and we'll see, affordability kind of snap back over time rather than, just an overnight snapback. For a 2008 style crash to happen, you need something much bigger, like a mass job loss or a global economic meltdown. The data right now doesn't kind of show that, which is why we're kind of seeing what looks more like a slow, kind of uneven market rather than a big collapse. And last section for the big macro headline is going to be Trump's 200 billion MBS buy idea. So MBS stands for mortgage-backed securities. So basically, Trump is saying that he wants Fannie and Freddie to buy 200 billion of mortgage-backed securities, kind of push down rates a little bit. I'll explain that a little bit more in depth at the end of this presentation when we talk a little bit about mortgages and so forth. But we're going to jump to the next slide. So next slide is talking about market update for sellers. So home prices nationally are kind of essentially flattening month to month. With about a 1% year over year growth. So this is signaling, stability rather than a collapse. So back in like 2022, when we did see like prices peak, the market went through kind of like correction phase. So this is why we're kind of seeing it kind of flatten and kind of go back to a stability over these past few years. And then buyers are cautious and payment focused. So pricing and conditioning really does matter when you're, thinking about putting your home on the market. So hiring a great real estate team that can help you, one, break down the market and the data, and then two, help you get your property properly prepared for the market is essential. So Houston is not on the national watch list for sharp prices decline. Other areas like Florida are seeing that right now. So the good news is Houston isn't seeing sharp declines on the pricing, just kind of like one off here and there. So we aren't seeing like an overall massive price decline. Overall, overpricing in the market kind of leads to longer days on market and not stronger negotiations later. So, for example, if you're looking to let's just say you and your agent having a conversation about listing your home. Let's just say 830 Azalea here. If you wanted to list it, let's just say for 2.8 million, and the market is telling you actually it's 2.4 million. So instead of listing it at 2.8 and thinking that the buyers will come in and they'll try to negotiate later down the line and get you down to 2.4. So what we see normally happen is like over time you kind of have those price reductions, and then you'll get down to the price that you originally thought it was supposed to be at. And then, then the buyer will come in and negotiate and try to get you down even lower than where the market value is telling you. So instead of listing it where we think market value is, and then, potentially having that early buyer come in where it makes more sense for them to come in and make their offer. And then market update for buyers. If you're currently, it currently takes around about 7 years to save for a typical down payment. So, it is down from a peak of 12 years. So showing affordability is improving slowly. To return to 2019 affordability, one extreme will need to be either, rates drop down to 2.65%, or we have a 56% increase in income growth, or, a 35% drop in the price of homes. So none of those are realistic. So it is kind of like wishing for something to happen that isn't going to happen. So the best leverage comes from buying before competition returns. So not waiting for the headlines to change, just taking action now and then either refinancing later and kind of go from there. But anyway, there is great news. 30-year fix fell to 5.99% from 6.2 last week. So we did drop into the fives last week. So that is awesome to see. And then quickly over builders and remodelers, housing stats, permits, and completions are down year over year as builders pull back. So we are seeing a little bit of builders kind of slow down their rate of production due to the fact of just like how the market is kind of turning out right now. So incentives help, but they do not solve affordability without income growth and balanced supply. So we are seeing some builders, give out good incentives in trying to get their product moved. But it doesn't do the trick for everything. Oversupplied markets are seeing price pressure, reinforcing the need for discipline, inventory, and pricing. So we are seeing a kind of, especially in the townhome market, influx of a lot of builders out there. The market's kind of saturated, so we are seeing, even especially on the resale side of things, it tick up larger days on market and struggle on the sale of each one of those properties. So interesting when it comes to new construction. And then the last thing is talking about the rates and economy. So I know I briefly touched on this in a couple slides ago. So the 30-year fix fell to 5.99 from 6.2 last week. So that's a 0.21% drop. So it does increase buying power by about 2.26. So for example, if you're going to take a $400,000 loan, that's going to be roughly around about $54 per month lower. And then you can buy around about $9,000 more house from that same payment. It's also about 1.16% lower than this time last year. So this time last year, it was around about 7.15. So it's great that the rates are coming down. So hopefully that will unlock some buyers that have been kind of sitting on the sidelines. Mortgage applications did dip over the holidays, but they're still kind of double digits year over year. So we are seeing more mortgage applications. Obviously, during the holiday period, people may take a little time out from the home search, but it is good that we are up year over year. And then next thing, talking about that Trump 200 billion MBS buy idea. So quickly on this would involve the government kind of purchasing 200 billion in mortgage-backed securities. The goal of this would be help kind of ease mortgage rates over time by increasing demand for mortgage bonds. This is not an approved policy yet, so it would not create an overnight rate relief. But if implemented, it could provide gradual support to the housing market rather than that quick fix. So briefly, what could this do? If executed cleanly, it could kind of nudge rates down modestly. Obviously not back down to 3%, what we saw like during the pandemic, but hopefully down a little bit lower. Obviously we even saw it drop this last week to 5.99%. So hopefully we do see that continuing. And then what it won't fix affordability at a structural level, but a small rate dip may help monthly payments. But if inventory and construction costs do not change, home prices, taxes, and insurances will continue to kind of behave how they've been behaving in the past. But it's good news that the mortgage rates are coming down a little bit, but it's not a drastic change. It's going to change the whole market in general. But hopefully you found this update helpful. Like always, I'll be in touch next week on another update, but have a great week.